Well, good morning, everybody. I'd like to welcome everybody to the SACS webinar on ASC 842 leases and you potential impacts. We're just going to give people seem to be rolling in. We're just going to give it a few more seconds for them to keep trickling in. But in the meantime, let's go over our disclaimer slide. Our firm provides the information in this webinar presentation for general guidance only and does not constitute the provision of legal advice, tax advice, accounting services, investment advice, or professional consulting of any kind. The information provided herein should not be used as a substitute for consultation with professional tax, accounting, legal, or other competent advisors. Before making any decision or taking any action, you should consult a professional advisor who has been provided with all the pertinent facts relevant to your particular situation. I'm Jason Borofsky, and alongside me to present this topic is Adam Holtzberg, a partner in the real estate group, and Adam's a senior manager. We're heading up the firm's lease implementation, which is finally here and why so many of you are attending today. We've given multiple presentations on this topic internally, going back several years now, and as we all know, it's been delayed. We're finally at a point now that the standard needs to be implemented. Our CPE information: if you wish to obtain continuing education credits in the form of CPEs, participants must stay connected to the GoToWebinar for the entire duration of the presentation. Partial credits not available. Participants must answer 75% of the polling questions. There are 4 polling questions, so you have to answer 3 of them. If you have difficulty answering the polling questions, that is, if your answer does not register, hit the escape key to minimize your screen and try again. If this does not work, please type into the chat box. The participant course evaluation is in the handout section of the control panel and should be downloaded and completed and emailed to jtozy@sacsllp.com to receive CPE credit. And in case anybody's worried about the slides, you always get a question. After the presentation, there will be an email link with the recording of this presentation as well as the slides. So let's get kicked off with the agenda for today. We're going to go through an overview of the new lease standard. We tried to focus the information at a high level on specific topics. I would suggest if you really want to do a deep dive into all aspects of the lease standard, the AICPA has a self-study that if completed, you get 10 CPE credits. We're going to go through examples of implementation. We'll go through various examples throughout this presentation, and at the end we'll go through a financial statement example, impact on companies. We're going to discuss transition, leasing software, impact on loan covenants, and at the end we're going to have a Q&A session. So there's a questions box. Put your question in there, and we'll either address it during the presentation or we'll save it for the end of the presentation in the Q&A section. If for some reason we run out of time, we can always follow up with you directly to help you. So without further ado, I want to introduce Adam Holtzberg, who's going to launch the first polling question and also lead us in the overview of the new lease standard.
All right, good morning, everyone. So let me launch this first polling question to get started. So where are you in implementing the lease standard? Give everyone like another 20 seconds.
I'm seeing some people that are done, so that's amazing for those people.
All right, so give it 3, 2, 1, and close the poll. And let's share the results. So it looks like most of you are just getting started, followed by the people who are done. All right, so getting into the actual standard, this standard's been around for a little while now. It was getting delayed a couple times. The first time they want private companies and not-for-profits more times so they could implement it. Then the pandemic hit, which delayed it again. But now it's finally here. So it will impact all financial statements with year ends 12/31/22 and beyond. So the primary objective of this standard was to address the off-balance sheet financing concerns, and it's primarily related to the leases, operating leases. There were some changes, some minor changes to, capital leases and lease store accounting, but the standard's main impact is on operating leases. And the whole idea is just to give greater transparency. So right now, under the old standard, operating leases are really just disclosed in the footnotes, showing the future commitments there. So instead, FASB, doesn't want that in the footnotes. They think most people don't read the entirety of the footnotes, so they want to now put that on the balance sheet. So the standard will introduce a right of use model. So what that means is you're going to have a lease liability for operating leases and a right of use asset. It also eliminates the bright line test for determining lease classification. And also just want to mention the impact of the standard is only on the balance sheet. So your income statement, cash flow statement, there's really no impact, or I should say no impact at all. The only impacts on the balance sheet and also some new footnotes, but the balance sheet could be significantly impacted depending on the amount of leases you have. So before getting started fully into the new standard, just want to kind of go over what leases are excluded from the standard. So short-term leases whose term is 12 months or less, that does not have a purchase option or renewal options, those are excluded. You would just expense those normally as you currently do. The other item also that you can also create a capitalization policy for leased assets, similar to like a fixed asset policy. So a lot of companies typically may have a fixed asset policy where they expense any new additions that are under $5,000, for example. You can do something similar for the lease standard as well. So that could be a good way to get around, for instance, from having to capitalize, a copier lease, for instance. So there are some workarounds around the lease standards. Just want to also mention, for people who have related party leases, you may think that you could do, a short-term lease now, a month-to-month lease to get around the standard, and we'll go over that in a little bit. So getting started onto the actual standard now. So the first step is really to determine what kind of lease you have. This is pretty similar to how it is on the current standard. There are some differences here. For one, they did change the name of capital lease to finance lease. So I'll probably be using the term finance lease, but that is pretty similar to the old capital lease. The only differences is They added one additional characteristic. So how it works is if you match any of these 5 characteristics on this screen, if you answer yes to any of them, that's now a finance lease. If they're all no, you have an operating lease. So under the finance lease, they added the 5th one is the asset, a specialized asset that doesn't have any alternative use to the leaseor. That's brand new under the new standard. The other item also is they got rid of what I mentioned before, the bright lines regarding lease classification. So in the past, they would have these percentages that are in parentheses. For instance, the lease term would be 75% of the remaining economic life. They now changed that to a major part of remaining economic life. Same thing for the present value. So we go to the next slide, actually. So the whole point of this was just to give a little more flexibility to companies. They want, it's definitely recommended and encouraged as a best practice to set up your own internal policies on, what the terms or phrases really mean. So what does it mean by reasonably certain or major part or substantially all? And that's just important so you're consistent with the leases as you go forward with this. You could still use percentages. It could still be the old percentages, but you just want to create a policy so you're consistent going forward with this. Otherwise, for finance leases, that's really the only major change. Otherwise, finance leases, the accounting of it is the same exact as it is under the new standard. For the balance sheet and income statement, there's really no other changes there. So with that said, you go to operating leases, and that's really where all the changes have occurred under the new standard. So operating leases now will now be presented on the balance sheet. There will be a lease liability and a right of use asset. So lease liability, that's going to be the present value of all the lease payments not yet paid, discounted using the discount rate for the lease. And then that'll be offset by a right of use asset, which will consist of the initial lease liability, plus any lease payments made to the lessor at or before the commencement date. You would back out any lease incentives received and also add back in any initial direct costs incurred by the lessor. So when you look at it, the lease liability is pretty fixed in what it is. It is solely the present value of lease payments. The right of use asset is kind of where you make any changes based on, the terms of the lease, any additions or unique aspects of it will go into the right of use asset. So going to the lease liability, there's really 2 areas that are probably the most important when determining, the present value. And that's a lease term and the discount rate. So under the new standard, the lease term is the non-cancelable period of the lease, along with any periods covered by an option to extend the lease if the lessee is reasonably certain to exercise that option. So basically what that means is at lease commencement, if you have lease options, you need to assess whether or not you will exercise those options, how many of those options, if at all. So that's definitely quite different than how you do under current standards. So the example here, we have the tenant enter into a 10-year lease for office space with 3 5-year options. The tenant is reasonably certain they will exercise 2 of the 3 options. So for purposes of recording a lease, the tenant will consider that to be a 20-year lease. There'll be the initial 10-year lease plus the 2 5-year options to get to 20 years. So with that, there are some factors to consider when determining what is to be the lease term. You want to look into the remaining term of the lease until the extension option needs to be excised. What's the total time and cost it will take to enter into a new lease? So that's going to be cumbersome. You're likely to exercise the option. Any leasehold improvements or modifications made to an underlying asset, and also location. Just want to focus on the third one, so leasehold improvements, modifications. This one's probably going to come into play the most. So essentially, there's economic incentives to stay. So essentially, you made investments. For instance, you have office space, you made significant leasehold improvements that have a useful life beyond the initial lease term. Then if there's lease options, you're likely to stay through those lease options. So that's something that you would have to consider. So for example, with a prior example where it became an initial 10-year term of 10 years, and they're excising 2 of the 5-year options. In that example, for instance, maybe there was leasehold improvements they made with a useful life of 20 years. So for that reason, it makes sense for them to excise those 2 options to stay for the entire period of that investment. Those are the type of things you have to consider when determining the lease term. So the other area is the discount rate. So this should be the rate implicit in the lease if it's readily determinable. In practice, that's probably going to be unlikely, as really only the lessor is going to have that information, and they're not going to be sharing that with the leasee. So if that's not available, there's 2 other options that private companies and not-for-profits will have. The first one is to use its incremental borrowing rate. So what this really means is essentially if instead of leasing the asset, if you were to go to a bank and want to finance the purchase of that asset, what rate would the bank give you? That is also could be tricky to determine, unless, for instance, you just recently purchased an asset with a similar term and payments. You're probably not going to necessarily know your incremental borrowing rate. So then there is a third option for private companies, not-for-profits. The only thing with this option is an accounting policy election. But what you can do is use the risk-free rate, which is essentially the treasury rate. So if you're entering into a 10-year office space, you would use a 10-year treasury rate. So if the risk-free rate is used, it's an accounting policy election that must be used for all leases of that class of asset. So, the prior example I just gave for the office space, if you elect to use a risk-free rate, you would have to use the risk-free rate for, all property, for all, any kind of building assets. Versus, if you have an equipment lease and your incremental borrowing rate for that, you wouldn't necessarily have to use risk-free rate. You'll be allowed to use the different incremental borrowing rates. So there is some leeway there when you make that election. Of course, once you make that election, you can't change it. Otherwise, you would have to restate your prior year financial statements. And just as I mentioned before, the rate utilized, if it's the incremental borrowing rate, has to be based on a secured borrowing rate. You can't use, for instance, an unsecured line of credit or something like that. That wouldn't be considered for this. So basically, it's kind of a similar example. The company entered into a 10-year lease for office space. So the incremental borrowing rate used to borrow secured debt. However, this probably may or may not be available for you. You probably would not go through the trouble of going to the bank and trying to determine what that would mean to finance that. So in that case, the easiest option is to use the risk-free rate. Now, there is a downside to that, because the risk-free rate is going to have a much lower interest rate than your incremental borrowing rate. And what that means is on the balance sheet, the impact's gonna be greater. So under a risk-free rate, your lease liability and your right of use asset is gonna be much greater than if you use your borrowing rates. So that is a trade-off on this. And something to consider, especially if you have covenants or you look at specific financial ratios, which will have could be significantly impacted by that. So the other area is variable lease payments and how to apply this under the new standards. So you have payments that depend on an index, such as the consumer price index, or a rate, such as the prime rate. You would include that index or that rate for year one and use that for all future payments. You won't necessarily change the rate or index each year based on how it changes. It'll be fixed to what it was year one, but that would be included. If you have payments that do not depend on an index or rate, so for instance, that are based on performance, like percentage of sales or usage, those variable lease payments would not be included under the standard. You would just record the expense as it's incurred in that period. And also want to mention, so for variable lease payments that are dependent on an index or rate, like I kind of mentioned before, it'll be fixed year one. You will only reassess it if something else occurs. For instance, there's a change in the lease term. Otherwise, you would just record that current year activity as a profit or loss based on how the index or rate changes. So initial direct costs, this is for the right of use asset. So these are costs that would not have been incurred if the lease had not been obtained. And that's really the key point. So this is only if you're paying that cost because you're signing the lease. If it's costs that you had to, for instance, negotiate lease terms or conditions that would have been, you would have to pay that whether or not you end up signing a lease, that's not part of this. And these costs will be included within the initial measurement, the right of use asset, and then these are just amortized over the life of the lease. So we go to the next slide. So we have a company that enters into a lease of office space for 5 years. The company pays $100,000 at the time of signing a lease and determines that the initial lease liability is $331,213 based on the terms of the lease. The leaseor also provides the entity a cash incentive of $35,000, and then in addition, they use a broker, the leasee, to locate the property and pay the broker a commission of $10,000. So how that will work is, we go to the next slide. So you start off with the initial lease liability of $331,213. You have that initial upfront payment of $100,000, so that's added into it. The lease incentive is backed out, and that broker fee, the initial direct cost, is $10,000, giving you a right of use asset of $406,213. So you can see that the lease liability and right of use asset may or may not agree with one another. It will start off agreeing, but based on any other factors, you may pull those changes under the right of use asset. So we're going to jump now to the second polling question. How many leases do you have? We'll give it like 15 more seconds. All right, so 3, 2, 1. We'll show results. So looks like most of you have between 1 and 25 leases. And then we have a few that with 26 to 50 and a couple with over 50. So just going to go over quickly, the difference between lease modifications and remeasurements. So this is what occurs, after year 1, after that initial measurement, what if stuff changes? So the first one, lease modification, is a change to the terms and conditions of a contract, resulting in a change either the scope or consideration for a lease. So there's 2 types. Either it gives the additional leasee rights not included in the original lease, extends or reduces the term of the lease, or changes consideration. The other type is partially or fully terminate a lease by reducing the leasee's right of use to one or more of the underlying assets. So really when it comes down to it, a lease modification is a contractual change between a leasee and leaseor. And then the question is, how do you account for that? So if the leasee is required to account for a modification to a lease as a separate contract, if the leasee is given an additional right of use asset and the lease payments increase based on the market rate at the current time, you would then have separate leases. Otherwise, you would have to factor in the changes under the current lease. So we have a quick example. So in this example, the leasee enters into a 5-year lease for 2,000 square feet of warehouse space with a leaseor for $10,000 per month. At the end of year 1, the leasee and leaseor agree to amend the lease contract, and it will add 1,000 square feet of space for remaining years of the contract for an additional 6,000 per month. And we're saying for this example, the additional 6,000 is in line with the current market rate. So they'll make a monthly payment of 16,000 after the modification. So in this example, the leasee should account for the lease modification as a separate contract, as they're given an additional right of use asset, and the price of that additional asset is at the market rate. So they have 2 separate leases now. Their original lease for 2,000 square feet for 4 remaining years, and now they'll have a new lease for an additional 1,000 square feet for 4 years. So modification is really a contractual change between the leasee and leaseor. This is now compared to remeasurement or reassessment, and this is really where there's a change on the leasee side, on their factors that may have impacted things previously. So this is an event that does not involve a negotiation of lease terms and conditions, but there's a change in the leasee's facts, assumptions, or other circumstances. And there's a few different triggering events. We have 3 listed here. So it could be a significant event of a significant change in circumstances that is within the control of the leasee that impacts whether they're reasonably certain to exercise a purchase option or to extend or terminate a lease. Other events could just be the leasee elects to exercise an option that previously they did not think they would exercise, or the reverse of that they will elect not to exercise an option that previously they thought they would. During a reassessment, that's when you also need to reassess the classification of the lease. You would have to update the discount rate at that point in time, and if there's any lease payments that are based on an index or a rate, you would update that as well to what's the current index or rate. So the example here, There's a leasee that enters into a lease with an initial term of 5 years with an option to extend the lease for an additional 3 years. The initial term rent is $50,000. The extended term rent is $55,000. So at the time of lease commencement, the leasee was not reasonably certain to exercise the option, so they recorded a lease, 5-year lease with a 7% discount rate for $205,010. However, during year 3, they decide they want to stay, and they make a significant investment with the leasehold improvements, and now they have an economic incentive to exercise that lease renewal. So now there's a triggering event based on the change in circumstance. So in this case, at this time, when this occurred, the lease liability and asset was $90,401. Their discount rate, they're using an incremental borrowing rate, is now 7.5%. Previously, it was 7%. So they would now calculate a new lease liability over the now remaining 5 years, as they're 3 years into the lease and they're exercising the option for 3 years. So we have 5-year lease and now 7.5% discount rate. So based on that, they determine the new lease liability is $213,546. So to record this, it would essentially just be the difference. So the $213,546 minus what currently they have on the books of $90,000. So the journal entry would just be to debit the right of use asset by $123,145 and credit the lease liability by the same amount. So that's, could be a common occurrence for different companies out there that, you may or may not think you're going to extend a lease, but then something changes and you decide to do it. So this is how you would go about and doing it. You basically just have to go through the whole process over again, but under the new conditions. So now we just have a general example over a lease, kind of show how it flows with the journal entries as you progress through it. So in this example, a leasee enters into a 3-year lease and agrees to make the following annual payments at the end of each year. So you see here, $10,000 year 1, and so on. The initial measurement of the right of use asset and liability is based on a 8% discount rate, so it comes out to $38,000. So the next slide, we have a chart here. So you can kind of see how it breaks out between finance lease and operating lease. As I mentioned, there's no change with the finance lease. So the change is really on the operating side. And then we have in the bottom, the initial journal entry, you debit the right of use asset by $38,000 and you credit the lease liability by $38,000. We just go back 1 second. So on the finance lease side, you're straight lining the right of use asset. On the operating lease side, essentially you're reducing the right of use asset based on a reduction of the lease liability. The lease liability is reduced similarly, whether it's a finance or operating lease. Essentially you have an amortization schedule similar to any normal debt you may have, and it's reduced by a similar manner, and then the right of use asset is reduced by that same amount. So for year 1, for an operating lease, the lease expense, next example, is $10,000, which matches the lease payment. That expense will be the same under the old standard as well, $10,000. The lease liability, we're essentially taking that off the amortization schedule. It's reduced by 6,962, and then the offset to that will be on the right of use asset. The finance lease, that journal entry is the same as it would be under the old standard, so nothing changes there. And on the next slide, you just see the impact on the different statements. So just focusing on the operating lease, you have the right use asset, lease liability. The only other slight change would be that the lease liability, you would have a current portion that would be in your current liabilities. So the right use asset would be a long-term asset. You would have long-term liabilities for the non-current portion, and then the current portion will be the also there for lease liability. So there is an impact to any financial ratios regarding current liabilities, current assets. You would have that current lease liability, but no offset on the current asset sides. And then just going down, income statement, no change, cash flow, no change. Just once again, the impact is just solely on the balance sheet side. I mentioned this earlier about related party leases. So the new standard touches on related party leases, but kind of stays away from it. But basically what it really says is treat related party leases the same as you would treat any other unrelated lease. The only slight difference is that when it comes to lease term, you should more or less figure there's an implied lease renewal option. So essentially, even if let's say you have a month-to-month lease for a related party lease, you would have to take a step back and really reconsider that. There's different factors into play. Is there a considerable amount of money spent on improvements? Is there an economic benefit to staying for the duration of the benefits of the improvements? So just because the lease term says one thing, you kind of have to look past that and really consider what's the likelihood of them staying beyond that. So that's really the major change. The other aspect is, with leases, it has to be legally enforceable for this to apply. Sometimes with related party leases, it may not be written down. Even though you may not have a lease agreement, doesn't necessarily mean it's not legally enforceable. It just means it's trickier to determine. So definitely recommend having any lease agreements documented just to make things simpler. And then the other thing also as well, related party disclosures, that still applies. So all related party rent still needs to be disclosed in the footnotes. So last, we have a polling question 3. How many hours do you expect to spend implementing the lease standards? So give it like another 10 more seconds. So 3, 2, 1. I'm gonna close the poll. We'll show results. So let's say most people are thinking 1 to 50. Especially if you have just a handful of leases, that's probably not far off. Once you have a lot more leases, you definitely will be spending more time on this. So with that, I'm gonna now pass it back over to Jason.
Thanks, Adam. So I'm going to be going over the sale leaseback transactions, as well as go through some of the financial statement disclosures. So a sale leaseback is where one party sells an asset it owns to another party and simultaneously leases back all or a portion of the same asset. So the key really here is to determine if you actually have a sale that occurred and has to be evaluated in accordance with ASC 606, the revenue recognition standard. Some of the trip ups that where a sale might not occur, the sale must result in a change of control of the property from the seller to the buyer, and it really must be clear in the agreement, the change of control, and the repurchase option cannot be a fixed amount, as a fixed amount would not be reflective of the fair market value of the property on the exercise date. So it's very clear that if the sale has to be completed, and then once you determine that a sale is completed, you would recognize the gain on the sale, and then you would perform the lease accounting on the lease agreement that was entered into as sort of as two separate transactions here. Going through the disclosures, and there are a number of quantitative disclosures, whether on the financial statement or the financial statement footnotes. Specific to the quantitative disclosures, this is really where lease software really plays a significant role in your implementation, because essentially once you part of the leasing software, you're going to enter all your lease data, and you can run the disclosure report, which is going to report all the ratios that you will need as part of your financial statement preparation process. It really would be difficult coming up with these disclosures without the use of software, because it's really consolidating the information on all your leases into one disclosure report. So some of the examples we have here, the amortization of the right of use asset for finance leases, interest on the lease liability for the finance lease, your operating lease cost, your short-term lease cost, variable lease cost, which Adam went over in a previous slide, if you have any sublease income, and your total lease cost. And then it continues in the cash flow section for your finance lease, your operating and your finance cash flows. And on the operating lease, your operating cash flow, your fixed payment, your liability reduction, your new right of use asset for operating leases and finance leases. In the disclosures, you're also going to have the weighted average lease term for both finance and operating leases, and also your weighted average discount rate. And we went over the discount rate previously. The weighted average of those for both finance and operating have to be included in the disclosures. Now the qualitative disclosures, now this would be in your accounting policy. So these are required by the standard, the nature of leases and subleases. So this is where you would put in your general description of those leases, the basis and terms and conditions on your variable lease payments, the existence and terms and conditions to extend or terminate any leases. You're required to report your significant judgment and assumptions used in lease accounting. So these would include the determination of whether a contract contains a lease, the allocation of consideration in the contract between lease and non-lease components. You still have to disclose your related party leases, which Adam previously touched on. And there are some practical expedients and short-term exceptions as well. So we're going to go through an example. I thought it would be interesting to look at Walgreens, because initially when this lease standard was implemented, or not implemented, but came out several years ago, Walgreens was #1 in operating lease liabilities. I don't think they're #1 today with the number of leases that Amazon has entered into. But nevertheless, Walgreens previously is implemented. So this is their balance sheet. As you can see on the non-current asset section, you have your operating lease right of use asset, and the liability section is broken out between current and non-current operating lease liabilities. Now you don't see the financing leases on here because, and it's disclosed later in their financial statement, that the financing information is included in the property, plant, and equipment section. Now, I'm not going to read the whole accounting policy here, but we wanted to include it as part of the footnotes and really just run through. As you can see, they really checked off the boxes here related to the required disclosures. The first paragraph really details the general description of the leases, and also interesting, includes a section which we mentioned earlier about exercising, how they considered if they're going to exercise an option or not exercise an option when determining if to include it as the right of use asset. And they put it right here in the accounting policy that the significant investments within the leased property, which have a useful life greater than the non-cancelable term. So it's very clear as far how they're making those determinations. Now, in the second paragraph, they go into the determination of a lease, the lease classification, how they determine the incremental borrowing rate. They do have a number of debts, so they did choose interest on collateralized borrowing. Public companies don't have, aren't able to use the risk-free rate anyway. The third paragraph details the allocation between the lease and non-lease components, and also the basis in terms of conditions on the variable lease payments. And the last paragraph, the smallest, just details the finance lease disclosures. Now getting into the disclosure section of the financial statement. So in their note 5 leases, they really go through and disclose all the required information as part of the standard. So they have balance sheet supplemental information, which provides the operating and finance lease. And this is where they disclose in the finance lease section that that's included in property, plant, and equipment. And the liabilities are included in the accrued expense and other liabilities. While for the operating leases, they have them as separate line items on the financial statement. This is probably due to their materiality. The statement of earnings supplemental information, they have their operating lease cost, so they break it out between the fixed and the variable rates. And their finance lease cost, they disclose their amortization, interest. We talked about the sublease income. You do have to evaluate these assets for impairment, so there is some impairment that they disclosed here as well. And they do have some sale leaseback transactions as well, which are disclosed here. Other supplemental information, they have their cash paid for amounts included in measurement of the lease obligation. So this is your cash flow information. You have your right of use assets attained in exchange for new lease obligations. You have your weighted average term and discount rates. So their operating leases are 10 years, finance leases 20 years, and they provide the discount rate. Now, without the use of software, you're not going to be able to obtain all this data to be included as part of the footnotes. It's much easier to utilize lease software, populate your leases. It's going to provide you with a disclosure report that's going to provide these exact numbers. Now moving into the transition for implementing the lease standard. So if you have comparative financial statements, you're not required to restate the prior year financial statement. The cumulative adjustments can be made on the initial adoption date. So if you're a calendar year end, December 31st, 2022, January 1st, 2022 is where you're going to be making those adjustments to the books. So you have a cumulative adjustment on the initial adoption date. Now you can elect to apply transition relief, but it must be applied to all leases, where you do not have to reassess whether existing contracts contain a lease on the adoption date. You don't have to reassess the lease classification for leases on the adoption date, and you do not have to reassess the initial direct cost for leases on the adoption date. You can use hindsight for lease determination for any renewals or purchase options. And overall, leases will recognize the lease liability at the later of the initial adoption date or the lease commencement. So obviously, if your lease commenced in 2022, that's where you're going to recognize the liability on the books. And again, that liability will be recognized at the present value of the remaining rental payments. So now is really the time to implement the standard. You do not want to wait to close to year end or after year end, especially considering when you have software consideration. You're going to have to choose a software. So this is the time to meet internally and with your outside advisor to come out with a game plan, really determine what software you're gonna be using, who's gonna be inputting the assets, and if it's, for example, if Saks is inputting the assets, we have the software, we have the knowledge to be able to do so. If the company chooses to do internally, who at that company is up to date on this lease standard, and in addition, they will also have to get training on the software. The software is only as good as the information you put into it. So you really have to be knowledgeable of the standard to be able to input the correct information. And as I mentioned at the beginning, the AICPA has a really good self-study that will sort of help you get up to speed. Now, August to December, gather your lease documentations, lease abstract, enter information into the lease software, and really resolve any questions or issues you have now versus waiting until year end. I know we get a lot of questions on related party leases, or should I include this exercise of option? So while you go through each lease and start entering them, questions are going to come up. And you also have to leave time to perform review of the data that was entered. So somebody should be entering the leases, and then somebody should be reviewing it. And ultimately, at year end, you're going to record the journal entries. Now going into the loan covenants, FASB ultimately concluded that the effect on the entity's covenants for debt or loan agreements is unlikely to be significant because they feel frozen gap or semi-frozen gap clauses would be included. The bank's outreach revealed an ongoing commitment to customers, and the operating lease liabilities are operating obligations and not considered debt. I would highly recommend you reaching out to your lender to determine the effect of the new lease standards on your loan covenants. Much better to do so now, where potentially some of the wording in the agreement could be updated before year end. Because once this is recorded at year end, there's going to be immediate increase in assets and liabilities on the financial statements, and you might not even realize how great that number will be until you ultimately enter all the data for the leases, especially if you just entered into a lease and it's a 10-year term. It's going to present value that 10-year term on your financial statements, and the number will be significant. So open conversation with your lender is always recommended. So I think we're going to launch our fourth polling question here. So have you found this presentation helpful? Yes, absolutely. Or best webinar yet? So we'll just leave it open for another few seconds. Seems like most of the votes are in. So if Adam, you want to close that out. So yes, I'm happy to hear. Yes, absolutely. And also there are some that say it's the best webinar yet. So now I see there's some questions in the chat box. You know, you will be receiving a link that you'll be able to view the recording of this webinar, as well as be able to download some of the slides. Somebody asked about the impact on leasers. There's very minimal impact on leaseor accounting. The AICPA training, it's like a 200-page training, and I think like 3 pages are dedicated to leaseors. So it's very very minimal.
I see someone
We
asked a question regarding straight line rent. So basically, under the old standard, straight line rent, you take all the lease payments over the life of the lease, and you get the average lease expense from that. So you average all the payments over the years of the lease and get that average lease expense. So that still is a thing under the new standard. There is deferred rent. It's not going to be a separate balance sheet account anymore. It'll just be combined into the right-of-use asset instead. But that is still definitely part of the new standard.
we have a question if materiality comes into play when evaluating whether a lease should be considered a finance lease. If it's really, you have materiality should not come into play if you're deciding if it's an operating lease versus a finance lease. There's a question here: if a company's not borrowing to pay rent, is there an example? You know, whether you're borrowing or not borrowing, you still have to implement the new standard in the way that the examples demonstrate. You're not picking out whether you're borrowing or not borrowing. You still have to pick that incremental borrowing rate or discount rate to be able to record the transaction here. And I
Looked at the question regarding termination clauses. So that also will have to be considered when you're determining lease term. So if the leasee can terminate, by themselves, and you think you will terminate lease early, you would have to make that adjustment to the lease term. If there's a termination penalty, you would have to include that as part of the present value of lease payments as well.
So Adam, I think we reached the end of our hour. Our contact information is on the screen. Feel free to reach out to Adam or myself or your SACS advisor. Again, the link to download a recording of the presentation and the slides will be sent out in the next few days. Thank you everybody for attending.